Welcome to All Things Financial with Jack Driscoll. Each week, Jack takes on all things you thought were hard to understand about your finances and makes it fun, easy, but most of all interesting. From insurance to the best way to save your money and squeeze the most out of the dollars you put aside for your rainy day. And now, you have a friend in the money business. Here's your host, Jack Driscoll.
Welcome back, everyone, to another edition of All Things Financial. We're near year end, and I'm continuing in basically a 2 or 3 part series, depending on how I'm able to get through it, on year-end planning and maybe the beginning of next year planning too. What we're looking into last week were opportunities to take advantage of the end of the year. So we look at this, and it's time to what? Celebrate families, celebrate life. So we look into this on the financial planning world, and we say, you know, when we celebrate families and spend a lot of time with our families, sometimes with family members that we don't see often or are coming in from out of town, or we're traveling out of town to go be with everyone, it's a good opportunity again to look and see how can we help each other be better off. And near year-end planning for financial planning, last week I talked about and began talking about some of these gifting strategies that sometimes, and I call it legacy planning. I've seen it written as legacy planning. We don't always know what legacy planning means, so I'll tell you what I think it means. I think when people die, I think the kids get the money. I think they fix up their houses. I think the money's gone and everybody starts over again. That's what I think. If it wasn't that way and it was true legacy planning, then wouldn't we have from generation to generation accumulating estates? Wouldn't we have whatever our parents had when they got the farm and they built the farm? Then wouldn't we have multiplied over every generation? Wouldn't we all be wealthy today? Heiresses and barons and all. If our fathers and our forefathers had accumulated assets and then those assets transferred down from generation to generation, continuing to accumulate, wouldn't we all be in a different situation than we are today? So to me, that's, wait a minute. We need to stop and think about this. Can we do or establish a legacy for ourselves that after we're gone, our life here on earth and our efforts and what we've accumulated can benefit generations upon generations upon generations to come long after we're gone? Is that possible? Well, sure, it's possible. If you don't waste all your money, if you don't run out of all your money, if you don't blow all your money. So you need to, everyone listening and watching, sit and evaluate what you think your purpose is for what you've accumulated in your life and what you're trying to do. Is it true that you're trying to help your family and grow and help get your kids through college and get your grandkids going and all that, but then when you die you don't care anymore? Or is it that you've just never thought about it yet? And if it were possible, would you want to create a legacy estate that lives long after you're gone? Would you want to create a trust fund? Would you want to put assets aside that no one else after you could blow? Maybe they'd be able to utilize and benefit them in their lives, taking some portion of interest only, but never touching the corpus or principal. I bet you don't think about that. You know, we have these rules called stretch IRAs and beneficiary IRAs and all these Roth IRA provisions that we have such wonderful provisions in the tax code that our kids and grandkids can inherit and not owe tax all at once, not have to cash in. But you know what, folks? It's like the rest of us. Without a map or a plan, we're going to blow the money anyway. So one of the legacies you can leave is education. You could talk to your kids and not be so private sometimes about, I'm not going to tell you what I have. We're not going to talk about money. We're not going to talk about dying. We're not going to talk about if I get sick or go. We're not going to talk. Okay, fine. But when money gets dumped on them, if you were successful and didn't run out of all your money because you went into a nursing home, you didn't teach them what to do. Well, they'll know what to do. Yeah, they'll know what to do. But that money will go along the same path. So we look at legacy planning and financial planning. We look at helping charities. We look at establishing foundations, private foundations. What is a private foundation? Did you know for as little as $10,000 or $25,000, you could set aside funds and actually have a private foundation that benefits a cause in your name that lives on forever? Give our office a call. We help people in legacy planning. Financial planning to me means life planning, but it's through lives, it's generations, and it's legacies. So we look at this and we say, number one, why should we care? Well, some of you will and some of you won't. And I can't change that. Sometimes I can by explaining it's possible to have your money outlive you for generations and generations and generations. We run into a situation where you'll say, my kids would just blow the money. I already know that. My grandchildren would just blow the money. Listen, folks, everybody's situation's different. Some of you have handicapped children. Some of you have handicapped grandchildren. Some of you have grandchildren that aren't even born yet that are going to have difficulties. And if you knew that before you died, you may have trusted money, put money in trust for them for the rest of their lives. But you died and they weren't born until the year later. And had you known, you would have done things differently. Well, think about it in advance and say, wait a minute, there might be cases where I don't want to not be able to help them even after I'm gone. So legacy planning comes into that. We gift money to charities, we establish private foundations, and we do these gifting strategies, some of them like I talked about in last week's show. Well, I want to get beyond that, and I want to talk about a specific number of planning opportunities. One of them are IRAs. A second of them are Roth IRAs. A third, which I talked about on prior shows, so we won't go over those again. Third, gifting strategies for capital assets like stocks and bonds or cash. And I want to talk today about some college planning. Just briefly, we'll probably get into it very early in the year, college financial planning. And what that means is not only planning financially for funding college, student loans and financial aid, but also setting money aside for investing toward college educations in the future. One of the most popular today is the 529 plan. So the way 529 plans work, I brought in a guide that I want to share with you. There are some opportunities on college financial planning, and one of them is this 529 plan. Now, what happens with a 529 plan is you're setting money aside. You can control who owns it. You can control who the beneficiary is. So you have an owner, but that's not the person that you're donating money for. So you might say, I want to set aside money for little Johnny, my grandchild, or my 3 grandchildren, or my 5 grandchildren. But I'm 80 years old, you might say. So I want my son or my daughter to own the account on behalf of the grandchildren who are the beneficiaries on the account. So you look at that and you say, okay, fine. But I also, because I'm age 80, you might say, I don't want to do this yearly. I want to try to shift assets out of my estate into the 529 plan now. And I want to also be the first to establish the 529 plan that others can contribute to at Christmas time or birthdays. So we might, as I said in last week's show, gift the fire truck and the Tonka toys and the Army sets and the Star Wars sets, but also in addition make contributions to the 529 plan that, yes, the grandchildren have no appreciation for it all. The parents do. But you're giving the gift to the child whether they know it or not. And that's sometimes just as important. But so can other family members. So you've set the plan up so somebody can contribute $100 into it. Isn't that nice? $50 or $100 can go in by anybody who wants to. You're giving access of the account number, and they can continue trickling gifts in to help these same children. So that's a wonderful way to do gifting. But for you, let's say you're starting the account, you want to shift assets, reduce the size of your estate. You're allowed to gift up to 5 years in advance to a 529 plan. And get this, it's possible, because we're in Pennsylvania, to possibly deduct a portion of what you contribute into the 529 plan. Tax deduction. So if you accelerate your contributions up to 5 years, you could put up as much as $70,000 per child and establish a 529 plan, and in essence, shift up to $70,000 out of your estate. We're near the end of the tax year, and we look at these opportunities. Well, so can your spouse to that same grandchild. So we might have an income shifting strategy or an asset shifting strategy here of up to $140,000 shifted into a 529 plan on the benefit of a grandchild. How about that? What if you have 5 grandchildren? Do you see the opportunities already? If you're looking to shift assets. Now, some people will say, I might go into a nursing home. I don't want all the money to be wasted. If I go into a nursing home, I have long-term care insurance. I don't want all my assets exposed. They do estate planning. You'll see someone who says, I'm worth over $10 million. I have a federal estate planning tax implication. They might do some of this asset shifting. There are a lot of reasons. We might not do it for estate taxes at all. But none of this, what I just said, this 529 plan, is reportable. It's automatically, it is reportable, but you won't be taxed on it. They won't be taxed on it. A 529 plan is tax-free, including all the accumulations that build up in that plan, if it's used for the intended purpose of higher education expenses for that child, for that beneficiary. And 529 plans, let's say we have a child that goes to college, and the assets that are in that 529 actually exceed the costs. There's so much money in there on behalf of that beneficiary that when that beneficiary graduates college, the additional funds can be, you could change beneficiaries. You could change owners too. They're very flexible. You could change beneficiaries and it can go down to the next generation, down to the grandchildren, or down to the great-grandchildren. Folks, that's a benefit in 529s I don't think most people understand. It doesn't take much money to open a 529 plan. So because I throw around big numbers doesn't mean you have to have big numbers. You're able to set aside funds. We've talked about UGMA accounts and UTMA accounts, Uniform Transfer to Minor accounts. That's when we're gifting money to minors under age 14, where we're saying we want all the accumulation on those assets to be tax-free if they're used, or, well, they're tax-free up until age 14, as long as they don't accumulate beyond a certain amount, because the child has a standard deduction in their tax benefits that they don't owe any tax. They can earn up to so much money every year and not owe any tax. So it's kind of tax-free that way. And then after age 14, it's a very low income tax bracket. So we use that as sometimes an income shifting strategy. But this college planning is actually a tax-free vehicle, that the assets grow tax-free if they're used for the intended purpose, which is higher education expenses. And so you contribute this $70,000, and let's say it grows over 16 years to $400,000. And let's say college only costs for that beneficiary $200,000. Well, the whole $200,000 is tax-free if the withdrawals are used to pay the expenses of the higher education for that beneficiary. The funds left over continue to accumulate tax-free, maybe for the next generation or maybe for a different beneficiary in that same generation. But it can be changed, folks. The benefits can be compounded. The tax advantages are compounded. And let's say that residual $200,000 grows for the next 20 years. And it is all tax-free if named beneficiaries then on the 529 are now grandchildren. And let's say that $200,000 has grown to $600,000 now. And there are 3 grandchildren. Well, by then it might cost $600,000 just for one of the grandchildren for college. Who knows? But in any case, what a legacy on an initial contribution possibly of $70 or doubled that, $140,000 for your couple that was 80 years old. So you look at opportunities here in these 529 plans. Now, they are also, in most cases, structured as being creditor proof. So what that means is the assets are somewhat sheltered against creditors. And you know, we didn't talk about this too much, but a lot of IRAs, Roth IRAs, 401k accounts, traditional IRA accounts, life insurance, sometimes annuities, can be creditor protected. So you want to look at that. And I've even heard the attorneys say an IRA of a spouse at home, if the other spouse is in a nursing home, might even be sheltered from the nursing home being able to get the IRA assets of the spouse that's at home. So, you know, all these rules are complicated. There's an estate recovery provision that says, yeah, that those assets may be protected on the spouse at home, but when the spouse at home dies, the estate assets of that spouse at home now might be able to be claimed by the nursing home or by Medicaid, the Department of Public Welfare, even after both spouses have passed away. But then the attorneys tell me, yes, but they're only allowed to make claim to the probatable estate. And the IRA, by having correctly named beneficiaries, is a non-probatable estate. Therefore, circumventing that rule and still staying creditor protected and Medicaid protected. Hey folks, does this sound complicated? How many times have I told you in prior shows? Don't try to do this yourself. Give our office a call. I'm a certified financial planner. I'm studying all the time to try to help families and businesses make the most of your assets. So we get into this 529 planning. We get into year-end planning. Imagine the business owner who calls me tomorrow and I find 10 or 15 opportunities of year-end planning that I haven't even talked about over the show. Sometimes we explore unique individual circumstances that are unique only to that individual. They're unlike any other individual. And we have opportunities to take advantage of before the end of the year. So if you are looking to get someone to explore your personal situation, see what opportunities arise for short-term planning, but also begin planning with a map of your life for long-term planning, give us a call. We work with attorneys. We'll work with your current and present attorneys, with your accountants. We'll work with your professionals. But this is important year-end planning. Again, when we get to these 529 plans and we get to these gifting strategies, we have opportunities that I think a lot of you may not know exist. And they're very flexible. They're protected. In many cases, we could share with you what the protections are. And you may be able to share this information with your neighbors and your friends and your family. So share this. Share this show. Get on our email list. Get on our newsletter list. Get others that you know on our list so we could share these same information with more and more people. That's why I do the show. It's a public service to help as many people as I can. I need your help to help as many people as I can. So please share us with others and share others with us. I want to help as many of you as I can. I'll continue doing the show with ideas such as this. We're out of time for today, but give our office a call and we'll be back next week with another edition of All Things Financial.
Securities and investment advisory services offered through SagePoint Financial Inc., member FINRA SIPC, and registered investment advisor. Insurance services offered through Driscoll Insurance and Financial Services Inc., which is not affiliated with SagePoint Financial Inc.